Hi everybody, Brian here from quantlabs.net. Just want to talk about the paired trading, how it works. This is a simple co-integration crypto spreadsheet. Basically, to get to this level where I list out longs and shorts where they're cross-referencing each other. I have talked about this in a past webinar, but just for those that may have missed it, I'm just trying to think of where I can find it. Anyways, doesn't really matter, or does it? No, it don't matter. Anyways, what happens is we have 18 pairs against US dollar from Kraken the exchange. We take at that point we do it every hour. We run a analysis on each coin against US dollar to see the strong and weak players by doing a analysis on longs and shorts and bid and ask versus each coin. So what we do is we can then determine, based upon, for instance, if there's more asks than longs, it's safe to say that price will go up. It's been confirmed multiple times. So we can take the three strongest out of the 18 that have the most amount of longs versus short ratio, I guess you could call it. And then we do the opposite, where we take the three weakest that have more shorts than longs. So we do the top three strongest in terms of longs, and then we take the three weakest. So that's how we're able to determine the pairs. And then I'll do a co-integration against each combined pair to see if any of them are co-integratable. So if they're less than 0.05, it's safe to say they can have co-integration. Doesn't mean they are, but they can. Like, that's past data, and we're using 500 data points, daily data, 500 days worth, to do these p-value co-integration. From there, what we determine is we're looking for pairs that are less than 0.05. So there's two sets of charts that come out of this. That is part of the report data goodie batch file, goodie directory zip file. First thing we can look at are the moving average spread between, let's say, the very number one, which would be in this case XMR, as a long, short as BTC. So right now XMR shows to be the strongest. So if I was to pull up the moving average spread between the two, here's a spread over, I think it's a couple hundred days worth. And then we have a fast moving average and a slow moving average. And those are the two ratios that we chart on top of the ratio between the closing price over that time period. That's closing price each day. So you can see how volatile this ratio can be. And then we can see the averages in orange and green. And the other thing that we can look for is the Z-score. Z-score is important for co-integration, and this is part of that makes up mean reversion. So in this case, anything above or below these lines offer short and longing opportunities, where 0 obviously is the mean, and this is the Z-score. So I'm going to go over to show you what Z-score is. So if you go over to Investopedia, I'll just read out the first paragraph. Is a numerical measurement using statistics to value relationships to the mean average of a group of values. Measured in terms of standard deviation from the mean, the Z-score is 0 indicates the data point score is identical to the mean score. Z-score of 1 would indicate a value that is one standard deviation from the mean. The Z-score may be positive or negative, with a positive value indicating score is above the mean and negative below the mean. Z-scores measure observations, visibility, and can be put to use by traders to determine market volatility. Z-score is most commonly known as the Altman Z-score. So I'm going to stop there on the Z-score. You can obviously research it on your own, but we do use this as part of to measure integration. The key here that I've been told from, we'll call them the higher powers to be, You will read a lot of the blogs when you do pair trading on, let's say, Forex or crypto in this case. And you might not use enough data to see if the co-integration will hold moving into the future. So let's say if you're using 30, 90 days worth of data of daily data, let's say, and you think that's enough, and then you have a p-value under 0.05, and then you think moving into the future that that co-integration will hold. That's not true. So you got to measure at least, from what I've seen, a year's worth of daily data, which I do, but it's actually 500 days. And then with that amount of data as a test, you can safe to say it will hold into the future, but it's never guaranteed. So I run another set of charts and files. So the first thing I do is a lot of times these pairs are not stationary. So what I do is I have a log file called stationary. So if it is stationary, it gets logged. So in this case here, when it ran this test at long XLM, short LTC, data is stationary on this date and time period. So we can hopefully be safe to say we can use that pair as a potential pair trading for a certain amount of time. It's very critical you understand that. In Forex, it holds for a much longer period of time. I'll talk about that in the Forex section. But for crypto, it doesn't hold as long. It's very short term. It could be a few minutes, maybe an hour, a couple hours, but it's very short term. So we try to catch it while we can, and maybe, just maybe, throw in the odd trade for that, because it's stationary, meaning it's co-integrating and it's tradable. So again, you can look up the definition of stationary, but that's kind of what we're looking for. So as I've shown you two charts, but there's two other charts that are useful here. In this case, if we're looking at, I believe it was XLM and LTC as the pair, or sorry, in our case in the spreadsheet it was XMR and BTC. So XMR again is the long, the short is the BTC. So just as an example, we can hopefully look at that. So we'll look at the spread, and that's the spread between the prices of Bitcoin and the spread between XMR, which is Monero, and what was the other pair? BTC, which obviously is Bitcoin. So let's check out that chart. So in here, this is the raw spread cost. This is kind of the mean here. This is the test data that's been tested, and call it trained. From this point on, after this line, this is the line where it is moving into the future, testing to see if the pair is co-integratable. But we can measure that in another chart that I've got here called stationary Z-score XMR. And let's check out that. So here is the spread, and then that's the mean of that spread on top of what we're looking for. Really is this. It's not stationary. Okay, so if it's not stationary, even though it may look stationary, it doesn't hold into the future, and that means it's really not a pair trade at all. It doesn't co-integrate. So when you look at the other file, I just showed you the spread. What we're looking for is the profitable opportunities between this mean here, the red, versus the dashed lines is this positive 1 standard deviation and the negative standard deviation. So this is the red, this raw spread. This is the Z-score. And then here, this is just used to measure volatility on the daily percent change moves between the two. So we can show you maybe some form of relationship. So that's what these charts mean, but it is rare to find a pair that does actually co-integrate into the future. From what I've been testing, it's early days, but at least I found one example of that file here in the stationary.log. We track that. So that's what I want to show you, and we shall talk to you later. Hopefully I'll have some trades to show you that cointegrate. Talk to you later.